You need to understand what happens to your pension and your ISA when you die, so that you can make sure that your wishes are met. We've looked at putting money in, how they grow, and how you get money out, all in the last 2 videos. And now we need to look at the end game. Hi and welcome back to the channel. My name is Pete Matthew and I'm a 26-year veteran chartered financial planner based here in the UK. And this video is brought to you by Meaningful Academy Retirement Planning. More on that in just a little bit. Now this video is going to be released shortly before Chancellor Rachel Reeves's budget on the 30th of October 2024. And there is a chance that some of what I say here might change in the budget. But if it does, I'll revisit the subject and I'll put a flag up here to the update video, if there is one. If there's no flag, there's no update video. I've stayed away from speculation about what might happen in the budget because it just serves no purpose. But when we know what's going on, I'll be right on it. I'm going to be putting out a response video on budget day, and then on Monday the 4th of November I'm going to be doing the live post-budget Q&A right here on the channel. So make sure you subscribe and hit the notification button to make sure that you don't miss those. Right, let's look at what happens to your ISA first when you die. When you die, the ISA wrapper dies with you. So whether you hold a cash ISA, a lifetime ISA, an innovative finance ISA, or a good old stocks and shares ISA, the wrapper, the tax wrapper, the ISA nature of it is removed from the date of your death. Now that means that the underlying holdings, the funds or whatever, they are now taxable. And so any income produced by them will be payable by your estate. Any gains made on them, if you sell them, will be paid by your estate until the assets are passed to your beneficiaries. Now the underlying funds or whatever, they are often sold by the executors and turned into cash, and then distributed to the beneficiaries. But that's not mandatory, actually. The holdings can in fact be retained and continue to grow while the estate is being sorted out. And that makes sense to me, especially as the process of probate, which is kind of getting the all clear from HMRC to distribute an estate, that can take months and sometimes even years. While the ISA wrapper disappears on death, if you're married or if you have a civil partner, they get something called an additional permitted subscription amount on top of their own normal £20,000 ISA subscription that they can add to their own ISA, and that is based on your ISA balance. So they have to use this extra one-off allowance within 3 years from the date of your death or within 180 days of the completion of the administration of the estate, whichever is later. Now the amount of that extra APS allowance is either the amount of your ISA, the value of it at the date of death, or the value at which it stopped being the continuing account of the deceased. In other words, when it transfers to the spouse, whichever of those two values is the higher. Now, non-UK residents can't generally subscribe to an ISA, but they can benefit from the APS allowance, so that might be important to some of you. But despite the sort of wrinkles about it all, to all intents and purposes, this APS allowance allows your spouse or your partner to inherit your ISA. ISAs are subject to inheritance tax, of course, if the value of the overall estate is large enough. But there's never any inheritance tax between spouses, remember. So for a married couple, really that's only likely to be an issue when the second of a couple dies, assuming, of course, they leave everything to each other on the first death. So let's look at pensions now. And as always, we need to separate these into defined benefit pensions and defined contribution pensions. Now with defined benefit schemes, those are the ones where you get a guaranteed income one day. Death benefits are fairly straightforward. But what happens on death is dictated by your individual scheme. So you need to check your scheme rules. Generally though, if you die after you've retired and you're drawing a pension from the scheme, a pension will continue to be paid to your spouse, but usually at a lower level than your pension. Often that's half. Sometimes it's 2/3, sometimes it's only 1/3. So check your own scheme to see what your partner will get if you die first. If you die while you're an active member, still building up benefits in the scheme, then usually your spouse will get a pension from that point, and that will factor in your length of scheme membership and how old you are when you die. But please check your DB scheme rules, they're all different. DC schemes are more complex, but they're much more flexible. So when you entered into a pension, you should have completed an expression of wishes, usually a form or a letter, and it lets the scheme know who you would like to benefit from your pension when you die. Now what happens when you die depends on how old you are, when the worst happens. So if you die before your 75th birthday, your beneficiaries can inherit your pension completely tax-free in one of two forms. They can either just have the whole pot as a tax-free lump sum into their bank account, or they can receive your pension pot as a special beneficiaries drawdown. And from that, they can draw down tax-free for life, even if they're not old enough to draw their own pension yet. And this is a huge benefit of pensions, and it's so generous, I think that this might be the one thing that changes in the budget. The maximum tax-free lump sum your beneficiaries can take is capped by something called the Lump Sum and Death Benefit Allowance, or the LSDBA. Standard figure for that is £268,275, but your beneficiaries could get more or less than that, depending on your circumstances. If you die after you hit age 75, then your pension fund can still pass to your beneficiaries, but whatever they take from it, whether as a lump sum or as an income, they're going to pay tax at their marginal rate. So that means that whatever they take out is added to their other income in that year, and income tax is paid accordingly. But so what? Now that we know the rules, what should we do about it all? Well, under current rules, we can simplify all this by saying that pensions are really efficient as a vehicle for transferring wealth on death to a family. ISAs are better for providing tax-free income and capital gains while you're alive, but they are less efficient on transfer on death, the APS allowance notwithstanding. So if you have an estate where inheritance tax is likely to be an issue, it makes sense to spend down your ISAs first and leave your pensions intact because they're outside your estate. You'll also pay less income tax by drawing from ISAs rather than pensions while you're alive as well. Pensions, as I say, they're outside your estate, so there's no need to wait for probate to be granted before pensions can be distributed. They need to be distributed within 2 years of death to be tax-free. That's an important point. And just make sure that your expression of wishes is up to date. It isn't binding on the pension company trustees, but generally they will honour your wishes unless there's a really good reason not to. Now, before we wrap things up, let me tell you very quickly about Meaningful Academy Retirement Planning. That's my course on how to plan and execute the perfect retirement. There is a module in the course all about later life planning where I talk about all this stuff. Everything from inheritance tax planning, wills, trusts, powers of attorney, and even modeling estate planning using the amazing Voyant software that you get access to as an Academy member. All the info you need is at meaningfulacademy.com/retirement planning. And if you check it out and decide that it's for you, use the coupon code YouTube for a discount. I'll see you on the inside. Look, having both pensions and ISAs in retirement gives you options as to where you take the withdrawals that you need from. It also gives you options for estate planning. So you're going to need to decide whether you give more weight to your lifetime income and the tax efficiency of that, or whether you're going to give more weight to the efficiency of your estate after you've gone. Now, I suggest the former, right? Present needs first, but it's your life and it's your money. So we've covered putting money into pensions and ISAs, how they grow, how you get money out, and what happens when they die. If you haven't seen the previous 2 videos, I'll put a link to them in the description. The first one is right here. The 3 videos together make up a pretty good summary of the merits of each of the main accounts, and they should help you decide which ones are the best for you and when. So thanks for watching, and I'll see you in the next one. Cheers.